The main story revolves around Tesla's gross margins. This has been the key challenge impacting the stock, potentially shaving off $30 to $40 per share. However, the latest earnings report delivered an unexpected upside. Even the most optimistic analysts didn't anticipate such a strong gross margin recovery, with a 200 to 300 basis point beat. This signals that price cuts are now under control and margins are starting to improve. With gross margins trending back towards 20%, Tesla's stock is likely at the beginning of a strong upward trajectory. If this trend continues, Tesla's stock could soon have a 3 in front of it. Looking ahead, the long-term story is not just about deliveries. It's about Tesla's advancements in AI, autonomy, and robotics. The market was watching closely for stabilization in margins, as they couldn't afford to keep declining towards 13% or 14%. Now that margins have leveled off, it's a critical turning point, both in terms of cash flow and investor confidence. The concerns that have weighed on the stock, particularly around deliveries, are beginning to fade. China played a significant role in Tesla's performance this quarter, showing strong demand despite ongoing concerns in the EV sector. But the real game changer for Tesla's future growth is a sub-$30,000 vehicle. If that model launches by mid-2025 as expected, it will open the door for Tesla to shift from single-digit growth this year to 10%, 12%, or even 15% growth in the near future. That's exactly what long-term investors want to see: controlled margins combined with sustainable growth. During the upcoming earnings call, the focus will likely be on both margins and further details about Tesla's affordable vehicle strategy. While some investors may have been disappointed by recent updates on Tesla's robotics and AI programs, the broader vision is still intact. Tesla's leadership in autonomous technology is something Wall Street needs to see backed up by real progress. And that's what Elon Musk is beginning to deliver: tangible results rather than just ambitious promises. For investors closely watching Tesla, platforms like Seeking Alpha provide valuable insights, including the latest Tesla stock price targets, innovation updates, and analysis on Musk's strategy. Clicking the affiliate links in the description may earn the channel a commission while providing access to expert analysis. Comparing Tesla's performance to traditional automakers like GM highlights just how strong this earnings report was. GM had a solid quarter, yet Tesla's numbers indicate an even bigger turning point. This moment feels like the beginning of Tesla's next growth wave. With a sub-$30,000 vehicle on the horizon, combined with its AI and autonomy advancements, the company could be on a path to a market capitalization of $1.05 to $2 trillion. Despite skepticism from some investors, like New York City taxi drivers who remain bearish on Tesla, the next 3 to 4 quarters could prove to be a nightmare for those betting against the stock. If Tesla continues executing at this level, it wouldn't be surprising to see the stock at $40 to $50 per share in the near term. The political landscape could also play a role in Tesla's trajectory. If Donald Trump wins the next election, there's a strong possibility that EV tax credits will be eliminated. While this would be a negative for the broader EV industry, it could actually be a net positive for Tesla, given its scale and competitive advantage. Additionally, a Trump administration could fast-track regulations for full self-driving, FSD, and autonomous vehicles, potentially accelerating Tesla's robotaxi and cybercab plans by a year or more. Regulatory challenges have long been a hurdle for Tesla, especially in China and the US. However, if government policies become more favorable, it could be a major tailwind for the company. Musk's influence in a potential new administration could help remove some of the barriers that have slowed down progress on AI and autonomy. From an investment perspective, Tesla is arguably the most undervalued AI-driven company in the market today. The potential of its AI and autonomous divisions could unlock immense value. Looking at the impact of regulatory changes, a more business-friendly environment under Trump could drive additional upside, not just for Tesla, but also for other tech giants like Nvidia and Apple. 3 key factors could shape Tesla's future growth. First, the potential removal of EV tax credits would impact competitors more than Tesla, solidifying its dominance. Second, if autonomous FSD receives regulatory approval sooner than expected, Tesla could see accelerated adoption of its Cybercab service. And third, regulatory shifts could reduce pressure on Tesla and big tech as a whole, making mergers and acquisitions easier. Tesla's strategic position under a changing political landscape is one reason why its valuation could skyrocket. $1 trillion AI-driven valuation for Tesla alone is not out of the question. Musk's role in shaping AI policy could make Tesla an even more influential player in the tech industry. While the stock market will always have its ups and downs, Tesla's long-term growth remains tied to deliveries, margins, and innovation. If Tesla can continue scaling production efficiently while launching more affordable models, the company could reach over 2 million vehicle deliveries next year. That level of scale puts Tesla far ahead of traditional automakers, solidifying its lead in the EV race. Beyond vehicles, Tesla's AI and robotics divisions have yet to be fully priced into the stock. Many investors have been skeptical about Optimus, Tesla's humanoid robot, and the broader AI vision. However, as Tesla moves closer to launching fully autonomous vehicles and AI-driven services, these segments could add substantial value. This quarter's results have forced many bearish investors to rethink their stance. The significant margin rebound and the company's reaffirmed growth trajectory make Tesla one of the most compelling investments in the market today. A 20% margin target combined with 20% to 30% delivery growth next year could push the stock past the $300 mark in the near term. Looking ahead, one of the most anticipated milestones is the release of Tesla's sub-$30,000 vehicle. Expected in the first half of next year, this model will be key to unlocking mass market adoption. Once that happens, Tesla's growth could accelerate even further, especially in price-sensitive markets like China. At the same time, Tesla is steadily advancing its autonomous technology. Unsupervised FSD is expected to roll out in key regions next year, particularly in California. While it may not move the stock in the short term, it has the potential to be a game-changer in the next few years. This quarter's results have reaffirmed Tesla's position as the leader in EVs, AI, and autonomy. The skepticism around margins has been addressed, and the growth outlook remains strong. If Tesla executes as expected, its market cap could easily surpass $1 trillion, with AI and autonomy playing an increasingly central role in its valuation. Despite all the noise surrounding Tesla, the fundamentals remain strong. Demand in China is improving, production efficiency is increasing, and Tesla is checking every box that investors want to see. The long-term vision is clear: a future powered by AI, autonomy, and sustainable transportation. With each passing quarter, Tesla is moving closer to making that vision a reality.